Starbucks CEO Kevin Johnson presenting at a conference this afternoon, and the company breaking quite a bit of news. First, lowering their guidance for the third quarter of 2018 to 1% from 3% globally. During the presentation, Johnson said shareholders, quote, deserve better, and that he is determined to fix this. He talked a lot about growth at scale, with founder Howard Schultz, of course, stepping down as executive chairman next week. Starbucks also announced it will be closing 150 underperforming stores in its densely penetrated markets in 2019. This is up from a historical average of about 50 stores per year in the past. Beyond that, the company announced it would be slowing its licensed store growth. They'll also be hiring an outside consultant to focus on G&A efficiency and to help identify areas of opportunity for growth. They plan to return approximately $25 billion in cash to shareholders via buybacks and dividends through 2020. This is up $10 billion from their guidance in 2017. And here's what Johnson had to say about returning capital to shareholders back in April after earnings.
We're going to stay focused on driving the growth agenda that we've outlined, and at the same time returning more and more cash to shareholders in the form of dividends and buybacks. And we think that formula is a good long-term formula for shareholder value creation. And we've demonstrated that over the last 3 years, and I anticipate we're going to continue to focus on it from that perspective.
On top of all that, they also approved a dividend of 36 cents per share. As you can see, the stock is down under 2% now. Melissa, back over to you.
All right. Thank you very much. Kate Rogers in the newsroom. So is Starbucks a growth company, Guy?
No,
Still?
It's not a growth. Yeah. I don't think it is a growth company. I mean,
does the valuation reflect that?
It trades at 20 times forward earnings. I mean, that to me is too expensive. I don't want to give away what my vote is going to be, but I think given the landscape that we find ourselves in, at 20 times forward earnings, given the earnings growth that they themselves are talking about, the stock is too rich for me.
Although, I mean, look at the entire space. Look at fast food, look at fast casual, but definitely fast food. I mean, what's their peer group? You know, these multiples have gone up significantly in the last 4 or 5 years. McDonald's is more expensive than that. So I don't think it's a growth company here. It's a growth company in China.
But are their comp sales higher than 1%?
Yeah, they absolutely are.
Yeah.
And in fact, their comp sales are 5 to 6%. Right. I think they're going to grow, in that nature. And the big issue has actually been margins. But China, they're going to double their store count by 2020. I think that's growth to me.
I think Dunkin' Donuts, if you compare apples to apples, that's the right comparison right there. So Dunkin' Donuts is up basically 7%. The chart looks fully intact. Technically, it looks like it's breaking out. It hasn't been brought down by all the other issues that surround Starbucks. And I think people are staying clear of the Starbucks trade for a host of reasons other than just this.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.